I'm joined now on the floor of the New York Stock Exchange by Nancy Davis, founder of Quadratic Capital and portfolio manager of the Inflation Rate Volatility and Inflation Hedge ETF, ticker IVOL. Nancy, thank you so much for joining us today. So I want to first talk about rates. What's your thought about the movement in rates ever since Kevin Warsh took over of the Federal Reserve as chair and headed that first FOMC meeting?
Well, now the rates market has 50 basis points of hikes priced in before April next year. So think about coming in paying our next year taxes and having 50 bips already priced into the curve. So the market's really swung since the press conference to price in these hikes.
So I want to talk now about inflation. We were chatting about this, how the Fed is going to be considering inflation. We have the CPI, we have PCE. Is that the only way that we should be thinking about inflation and calculating inflation?
That's a great question. No, I think there are a lot of ways. Obviously, those are two indices which are calculated by government bureaucracies and agencies. They're like lies, damn lies, and statistics. And then there's the BLS, which is something special. So tips, which reset with CPI, are only the CPI index. I think that's what Kevin Warsh was really talking about was not using survey data, is rethinking how we look at inflation. And there are a lot of different ways to look at inflation, but I think the easiest one is the rates market, right? That's a huge market, 5 times bigger than the equity market. It's how where the rest of the world lends money in dollars. The Fed sets the policy rate only, but the term structure rates, that's set by the rest of the world.
So, as I mentioned, you're the portfolio manager of IVOL, that fund. Talk to us a little bit more about that fund for any advisors or potential investors that are not yet aware of this ETF.
Well, it accesses the rates market. It uses fully funded options on interest rates. And you could say, why would I care about that? I think that's a nice pairing with the ag index, which is what a lot of people use as core fixed income. 35% of the ag is actually short OTC interest rate options. It's called prepayment risk, but it's embedded inside of mortgages and also corporate callable bonds. So IVOL is long options, so it's always long vol. So it actually benefits from rising volatility. And it's kind of shocking because in today's environment, you would think inflation and interest rate vol is higher. It's actually lower than we were at the start of the year. It's actually fallen by about 50% over the last 3 years. So it's actually a really, really cheap time to be hedging because the cost of owning optionality is so low.
So, talk to us a little bit more about the fixed income investor and why they would want, interest rate volatility inside of their bond portfolio.
I think a lot of our clients take the ag index and then they pair IVOL plus the ag as a completion portfolio. So the ag index, which is what most people use for core fixed income, there are no inflation protected bonds, zero inside the ag. So IVOL, about 80% of it per prospectus is that type of treasury bond that resets with CPI. And then we add options that are on inflation expectations outside of CPI. And so I think it's a really nice pairing because the ag on its own gets hurt, right? When volatility goes higher in market expectations, that hurts the price, just like rates. Everybody's so focused on what's our duration risk, what's our exposure there. Mortgages, all these things that have embedded short optionalities, the same thing. Price of all goes higher in the market. The price in terms of market price goes down, just like interest rates.
Nancy Davis, Quadratic Capital, thank you so much for joining us. I'm Kristen Myers, and you're watching Asset TV.